Now this video is going to be a treat because I've got JJ from Dividend Freedom and my boy Ryan Williams ready to talk about the investing questions that you all submitted. Earlier this week, I asked on my channel for a couple of questions and topics, and boy, did you guys deliver. And the cool thing about this video is that you're going to hear from all three of us on each and every question, and so you'll be able to hear a different perspective or how we think about these things. I'm Professor G, and I made this channel to make investing simplified. Let's go talk with the other guys. Welcome, guys. Thanks for jumping on today. Real quick, let's go ahead and just introduce yourself, JJ.
Yep, JJ Buckner. I have the Dividend Freedom YouTube channel and from Missouri.
Awesome. And Ryan?
Yeah, my name is Ryne Williams, coming to you from Las Vegas tonight. And I also have a YouTube channel where I basically just copy everything JJ does. It's the same. He makes a video, I make the same exact one. See if I can top him. No, I'm just kidding. I also make videos on dividend stock investing. That's kind of my thing.
Awesome. And you guys know me, Nolan Gobert, Professor G, and my channel is Investing Simplified. First question is, what are your top 3 dividend stocks? Who wants to go first?
I'll go first. This one was a little tough for me because it's so hard to narrow them down just to 3. But I know my first one was one of the first two I mentioned. So the first one's Pepsi. I mean, it's been one of my favorite dividend stocks for as long as I can remember because it's so much more than just like a soft drink company with the amount of brands that's under that PepsiCo name. Cheetos, they have that partnership with Starbucks. I mean, Lipton iced tea. You look at some of these products and you're like, didn't even know Pepsi would have owned that. Next one's Microsoft. It's kind of self-explanatory. I mean, the amount of different business sectors and segments that come whenever you own Microsoft between, the Azure cloud computing, you have, the gaming sector, which hopefully that deal with ATVI goes through, Activision Blizzard, praying for that. And then my third top dividend stock right now, and these are all based on not really focused on valuations. These are more just like favorite brands type stocks I like to own in my own personal portfolio. It's Starbucks. And basically to sum that up, the reason why I love Starbucks is because everyone out there could stop drinking it and my wife would keep them in business.
I love it. Good. Ryan, what about you?
I'm going to have to second. See, I told you I just copied JJ with everything. Starbucks is definitely on my list. I am a huge Starbucks fan. You guys should see my coffee cup collection from that place. And that's value. I mean, that aside, it's just such a strong company. Great dividend stats. Love the dividend growth from Starbucks, which is definitely one of the draws for me to that company. Procter & Gamble is going to be my second one. And this is not in any particular order, by the way, but Procter & Gamble, it can't get any steadier and more stable than Procter & Gamble. We're talking Dawn dish soap. We're talking Tide laundry detergent, Crest toothpaste, pretty much any popular household brand that you can think of, Procter & Gamble owns it and they make it. And it's stuff that we're always going to need. So I feel really good having something like that in my portfolio. And the third one, it's kind of like JJ said, it's hard to come up with these because there's so many great companies out there, but I would have to choose Snap-on, ticker symbol SNA is one definitely in my top 3 because it's just another one of those really strong companies in the industrial sector that within that sector, just their tools have so many different applications for so many things. And you guys should look at the dividend stats, really high growth dividend stock, which is one of the main reasons I love it. But those would be my top 3.
Awesome. And I guess my channel is all about just copying you two because you took all 3 of mine, both of you. So in no particular order, Procter & Gamble, absolutely just consistent behemoths. I mean, they're not going anywhere. We got Pepsi, again, behemoth. And I get into little fights with people about Coke versus Pepsi, but I think Coke long term has been amazing. I think moving forward, Pepsi might overtake it, but we'll see. Either way, I mean, you can't go wrong with either of those two. But then my number one for sure is Microsoft, and partly because I'm partly a growth stock investor as well, and this one kind of hits all the boxes. So great picks, y'all. All right, the next question up on the list here was please explain why compounders are better or worse than high yielders.
Yeah, so I think when we were talking about it earlier, it was in the context of growth versus dividend. Is that right? And just looking at it through that lens, basically share price appreciation versus dividend income. I don't know that one is going to be better than the other. Really, if you think about it, they're two sides of the same coin. When you add both of those two things together in an investment, share price returns and then cash flow, it adds up to your total return, which at the end of the day is what it's really all about. And from that point, in some capacity, it comes down to a matter of preference. How much of your total return do you want coming from share price appreciation? How much do you want coming from dividend income? And that preference can be built on different things, just interest, what tickles your fancy. Do you get stoked seeing your stocks fly up in share price, or do you get more excited about seeing that Realty Income has paid you a dividend for not having to lift a finger, just cash straight to your bank account? In some capacity, like I said, it becomes preferential, and I don't really think one's better than the other. And we could get into timelines, how long you have till you're retired, and those sort of things as well. But that's my take.
Nice. Yeah, I went along the same path to a certain extent on that. And for me, I just ask, what is your goal? Are you looking for cash flow, regularly right now, or are you looking for just appreciation, and you don't need to see this money or touch this money for 10, 20, 30 years. And either way, depending on what your actual goal is, the only time that I would ever say one is better than the other is based on someone's situation and the other things that might come into play. So I agree with you. I don't think one's better than the other. I think it comes down to picking great companies or ETFs that are going to be solid, that are going to be around forever, and keeping it sustainable.
Can I add one more thing to that real quick, Nolan?
Yeah.
To your point too, like if you're setting up a college fund for your kid, if you're setting aside money for your daughter's wedding for the future, it might make more sense to have something that's going to grow in share price versus income. But like you said, it just depends. But those are a couple specific examples that I could think of where it's like, well, maybe share price might be more up your alley for something like that.
Good.
So I took this a little different route. I was basing it off of like dividend growth versus high yielders, because that seems to be a big conflict or, a discussion in the dividend space particular. Yeah. So for me, I tend to be more, if you look at my portfolio, I tend to be more of a dividend growth investor than versus a high yield investor. And that's for a couple of reasons. Basically, to narrow them down is one, when you have something, when I say dividend growth, I mean, they tend to be a lower yield and they're growing their dividends consistently year over year. They're not, we're talking anywhere from 0.5% dividend yield to, let's say, like 3.5% dividend yield. Anything above that would maybe be considered more high yielding. So I tend to focus more on dividend growth because one, I have a lot longer for that dividend to compound over itself. But two, it also tends to be usually solid blue chip type companies that, like you mentioned, Nolan, with PG, like they're going nowhere. Like these are safe, relatively companies that have good balance sheets. They're overall healthy companies. There's risk in every investment, but the risks seem to be lower. And then when you look at higher yielders, and I'm talking some of these are 10, 12+%, you may have stocks that you look at the 52-week dividend adjusted return. And if you, after looking at that, accounting for their high yield dividend, they're usually always underperforming the dividend growth stocks over the long period of time. And also, whenever you have high yields like that, if you look more into the company, there tends to be more risk. So for me and the type of investor that I am, I like sticking with the lower yields, dividend growth type companies.
Nice. Yeah. I'm on that team.
And that's one more thing. And that's not to say that you won't ever add the JEPIs to your portfolio, because I know I have that. I know JJ, you do as well,
yes,
which has
exactly.
a 10, 12% yield, but that's not going to be the first thing you go towards. Before you have your dessert, you're going to have your carrots. You're going to have the Procter and Gambles. You're going to have the Coca-Colas before you think about buying JEPI. Yeah. And I think that's important for a lot of investors to keep in mind, because it's so easy to be tempted by those high yields, but you got to walk before you can run, guys.
Yep. Smart. Great. Question number 2 here. What is your take on Realty REIT to add as a form of diversification for VU, QQQ, JEPI, and SCHD? Basically, we did get a lot of questions on REITs in general. So what are your guys' thoughts on REITs as a diversification tool?
So I love real estate. I love it. I have a couple rental properties myself. I also invest in Realty Income. I also invest in STAG, which is another REIT. And I think this is a great way to diversify your portfolio. If you have all just, single stocks that make up your current portfolio, to be able to invest in REITs is a great way to diversify. Now, when it comes to realty income, I love it as a stock. I mean, you can't beat the tenants, slash clients, whatever you want to call them, that make up their portfolio. I mean, we're talking, Dollar Generals, which if you're from small town America, like I am, they're in every small town you pass, 7-Elevens, Walmarts, Home Depots. I mean, we're talking the, household name brands that make up their clientele. Now, when it comes to REITs in a little bit more specific area, a couple of reasons why I like them in versus maybe physical real estate that I own myself is liquidity. You can buy and sell REITs very quick. When I want to go buy or sell a rental property, that could take 30 to 60 days to even think about selling it. Then that's on a good day, especially with how this market is. It could take a lot longer than that. But also the cool thing about REITs is they're legally required to pay out 90% of their net income. So, and dividends. So their dividends tend to be a little higher. You have a little higher payouts. And then for those out there who care when they get paid, a lot of them tend to pay on a monthly basis. So that's a cool aspect about it too. And it's just it's a low barrier of entry also. I mean, you can start investing in a REIT with like $1 to where, going buying real estate may take a little bit more money up front.
I mean, I second everything JJ said. REITs are awesome. And I think they're probably one of my favorite type of stocks to invest in. I don't have a lot of them in my portfolio, but I really enjoy them. And there's some great ones out there. Now, in this particular instance where it's like realty income in addition to VU, QQQ, JEPI, and SCHD, I don't think that's necessary. It seems like just with those 4 ETFs, you already have so much diversification. In fact, if it was me, I probably would get rid of some of those ETFs. Like I might not have QQQ. I might just go something like VU and SCHD or even SCHD and JEPI, and then maybe add a couple individual stocks from there. And if we want one of those to be realty income, I think there's worse stocks you could pick. But that's just me.
So I forgot to mention something real quick. I also wanted to mention that I saw that the question, is more focused on just like ETFs overall. If you do want that diversification, but you want to have more of a wide variety of just realty income, maybe look into something like a REIT focused ETF. Vanguard has one. It's VNQ, Vanguard Real Estate ETF, and like realty income, American Tower, Public Storage. You're getting a wide variety of different REITs that make up this ETF. Instead of going out and picking one single stock, you can kind of spread your money throughout many different REITs and diversify even more if that's something you're looking to get into.
Nice. Yeah, guys. I mean, I pretty much definitely, second or third what you guys have been saying. And, the general question here about diversification, I think a lot of people get hung up on that. And I think people think like, I need to have every asset class out there and I need to have a piece of literally every little thing. And I've heard real estate's a good thing to have. And so, and if that's the case, like, I think like what Ryan said, like you're very diversified in 2 or 3 ETFs. That's the whole point of the ETFs. And that's why it's so easy to invest in ETFs. But yeah, I mean, as far as is realty income a good stock? Definitely. And there are a couple good REITs out there. You guys have already named a bunch of them. Something that I would just make sure that you have on the top of your mind is that a lot of REITs are usually taxed differently than regular dividend stocks. They might be taxed in ordinary income versus qualified dividend income. So just be careful on that. Obviously, at first, when you are investing, you're not investing with a lot of money probably, and so the taxes are very minimal, and that should never deter you, taxes alone, but just know that that is something to think about. And so other than that, I think that, yeah, it's a great thing to add if you want to. You don't have to, though. This next question had to do with if this person invests in SCHD, they're asking, should they reinvest their dividends or should they have their dividends just cash out every quarter? And this person did ask specifically within a Roth and talking about a Roth, but I would like to hear your guys' takes on a brokerage or taxable account versus Roth, and maybe take it that way, because maybe I'll just start for this specifically. If your question has to do with the Roth, you can't really do anything about it, right? Like you're going to have to reinvest those dividends because you can't touch that income until 59 and a half. If you are 59 and a half or older, then yeah, I mean, that is a question that you can have an answer to. But if you're younger than that, your dividends will be reinvested back into the fund. And now you can have them reinvest directly back in, so drip directly back into SCHD, or they can go into like the money market of the Roth, and you can then invest that money into another ETF or another stock or whatever. But either way, you're not going to cash out that income. For me personally, we've had this conversation, actually, the three of us offline, which is pretty funny. For me personally, I like to reinvest my dividends. I'm totally fine paying the taxes on them right now and just letting it continue to grow. It's almost like a discipline thing for me. It's like I'm just keeping that money in there and letting that thing snowball, because I've seen the numbers and man, it grows fast. So I'm excited about that. I'm here for those dividends in a couple of years, not for the dividends right now. So that's my take.
So to play off that real quick, Noah, and I got a chart I wanted to share with you guys. It takes the S&P 500 back from 1960 to 2017, and it shows the difference if you would reinvest your dividends if you wouldn't over that span of however long that is. So let's
JJ, this isn't the one you did with the crayons, is it?
Not again.
Yeah, I know, right? So, go on, Ryan.
I already hung it up on my wall, man.
Oh, I love it. So,
sorry.
No, you're good. You're good. So if you assume you got 10 grand and you start back in, and this is based on the chart, start back in 1960, and you chose to not reinvest your dividends. You took those dividends as payments and you go use it to pay your electric bill or whatever you wanted to do. That would, at 2017, you would have an ending balance of $460,000 over that lifetime from 1960 to 2017. So almost $500,000. If you would have reinvested the dividends from the S&P 500, the difference is mind blowing. You'd come out to have a little over $2.5 million.
Wow.
So that shows the power in reinvesting your dividends. So if you're taking those cash payments as dividends early on, you're missing out on so much potential growth in the future.
Yeah, I honestly don't even know if I have anything to add to that, guys. Like you both hit the nail on the head.
The crayons.
Yeah. Yeah, that's my only contribution to this question.
So Ryan, would you ever think that it's a smart idea to drip your dividends in a way where you then can pick the investment that it's going into, or would you suggest, or would you rather it just drip directly back into the actual investment that you have?
I think for me, this has kind of changed the longer I've been doing this. When you first start out, your dividend payments, coming in are a few cents, $1, not too much. So in that instance, I think it makes sense. Just drip them back into those positions, let that grow. But eventually it'll get to a point where across your entire portfolio, and it will happen sooner than you think, you will be bringing in $100 a month, $200 a month, $250 a month. And at that point, you can really do some damage if you manually reallocate those dividends into other positions. And for me, it got to a certain point where I turned those automatic reinvestments off and just captured the dividends. And then, like I said, manually put them into other things, chose where I wanted those dividends to be reinvested. And I think it's natural for a lot of investors to get to that point. And like I said, you can really do some damage when you hone in and on what you want to invest in. It helps having those extra funds coming in to do that.
Nice. I like that. Sense. Yeah, definitely. I think that there are going to be, somebody watching this could be a newer investor, and that's smart to say, like at first, let's see how the market works. Let's learn how this investing thing works. Let's make it a little bit simpler so you don't have to have that to worry about. But as you've been doing this for a year, 2 years, 3 years, you start to learn some things, and you start to have some opinions and ideas, and you want to put the money where you want to put it. And I think that that's just the evolution of the investor. So I like that. Yeah. Cool. Let's do this question here. So recommended ETFs for different age groups. What are your guys' thoughts, or would you even say that somebody should have a different ETF based off of, or different ETFs based off of their age?
So to answer that question, it's very hard to give like a broad-based answer because a lot of that depends on like each person's like personal situation. An easy way out for me, I guess, to answer this question is I can just simply throw my favorite ETF out there that I hold in nearly every portfolio, and that's VTI. VTI is the Vanguard Total Stock Market ETF. It tracks the overall market, has over 4,000 holdings in the fund. So when you invest inside this fund, your money is getting spread throughout 4,000 different stocks, basically. Now, different percentages in each stock, but it's an ETF that tracks the overall market. And what I mean by that is, generally, when you look at like hedge funds and they see like how they did by picking stocks, or everyday investors by picking stocks, they compare that to a benchmark, and the benchmark is usually the S&P 500. But you can also look at VTI, which is they're pretty much like almost hand in hand the same returns every single year. So that's why I like to say I'll just take whatever the market's going to give me as a return for that year on average, because over a long period of time, it's very hard to outperform the market. Now, I have different portfolios for different situations, but like all my retirement accounts, majority of them are 100% in VTI. Now, if you start getting to an age where you're closer to retirement and you're maybe a little worried about money, being a little more in a risk investment, like single stocks, like a fund like VTI that's 100 stocks, maybe look at something like bond ETFs. Vanguard has a bond ETF, and I forget the ticker symbol right now, BND.
Yeah.
BND, Vanguard Total Bond Market Fund, or something like that. So it's a made up of government bonds, and you can go look at corporate bonds, and you can go look at what the actual portfolio looks like. But it's supposed to be a little less riskier type of investment if you're at a certain age where you're in retirement, close to retirement. And again, it all just depends on what your personal plan is.
This really is, out of all the questions we've answered so far, I think this one is the toughest because it can be so subjective. But I think one way to go about it is just to reverse engineer it. So let's just hypothetically, let's say you're someone who's closer to retirement. You've got 3 to 5 years left till you want to live off your income. Okay, well, what's that number look like? Like, how much do you need? How much passive income do you need to replace your active income to be comfortable in retirement? And then once you have that number, it's pretty easy to figure out from there, because from there, you can use something like, there's tons of great dividend calculators out there. You could go on the dividendtracker.com. They've got a couple of really great calculators you can use. And like I said, reverse engineer.
Thanks for the plug, dude.
Oh, anytime, man. That's what I'm good for. I figure if I'm going to do that crayon jab, I better redeem myself. No, but you can go on there and you can plug in these different ETFs like SCHD and JEPI or VTI, which are there's a wide range of yields between their VTI on the low end, JEPI on the high end, in the double digits with SCHD in the middle. And you can see how much you would need to have invested to generate the amount of income that you would need to retire off of. And then from there, once you have that number, how much do I need invested in SCHD to generate $50,000 of dividend income per year? If you think you can make that happen, if you think you can invest enough into SCHD in that time period, then go with that for sure. But if something like JEPI's going to get you there, then maybe go more with that. And you can always have a balance between the two or the three out of the ones we just mentioned. There's so many different ways to slice it. But I think ideally overall, in the long run, like JJ said, it's going to be better to go with something that's going to have more growth, because especially in terms of dividend income, because, the amount even once you stop contributing to it, the amount and reinvesting dividends, the amount that you make will still continue to grow as time goes on if you're having something with more dividend growth like SCHD, and you're not going to get that same income boost every year with JEPI. You're going to get more income today, but down the road as time goes on, it's not going to grow.
Right. You can also look at something like the 4% rule or 3% rule, depending on your risk and how much capital you have to work with.
Yeah, true.
A simple example of that is, if you have $1 million invested in like VOO or VTI or, in your retirement funds, you can safely withdraw 4% of that every year and not lose any capital. Like, there's been studies done. So basically you can pull out 40 grand to live off of every single year, and your account should still grow over time, because the average return in the stock market is around 8 to 10%. So if you're taking half of that return on average every single year, well then, yeah, technically, mathematically, that account should still grow and you should never run out of money. It's called the Trinity study. I think you can go Google it and research it a little more. But so if you may not have enough capital to specifically live off the dividends, but you have a large enough capital where you can take that 4% rule plus dividends that account's going to push out, well, then there you go. There's your retirement plan. It's just, you got to make sure you have that enough capital, to get there.
Nice. Yeah, no, that's super smart. And I think the only thing that I want to add, because you guys hit it pretty hard. Obviously, the first thing I would say is what you guys both started with, which is everything and every situation is different. And so I would ask many, many more questions before I'd even be able to give an answer on this. But I guess one of the ways that I took this question was, and what I'm seeing a lot is maybe somebody closer to retirement age, maybe 5 years away, say they're 60 and they want to retire at 65. And so they're asking this question, and I get the feeling that they're asking this question because they're asking, how can I have more money in 5 years? Like, what's the best way for me to make the most amount of money in 5 years? And what I would do is very much caution that thinking, because if you're going to pick something based off of high yield, like JJ's talked about before, or pick something based off of only high growth, the highest growth, there's a reason, there's a thing called risk and reward, right? Like, you may be able to get that reward, but you are risking something that is not worth risking, especially at that age. I would say, if you're 18, if you're 20, go for it, whatever, like you figure out your risk profile and you do the research, but you have a lot of time to make that up. At 60, you're there. Like, you want to be a little safer, not so safe that you're not making any growth or anything, but you want to make decisions that are smart, because it could go sour much, much more likely than it actually, crushing it to the moon like everything else.
Can I touch on that real quick? And this may be going a little off of the investing portion of this, but this is something I literally just had a discussion with my mom and dad, because they're nearing that retirement age. And they're maybe not as far ahead as they could be, but they're really been trying to catch up lately, and they're doing a great job at it. And one thing they're doing to really help minimize the amount of capital or money they need in retirement to live off of is they're budgeting their money very well, and they're getting rid of all of their debts. Yeah. They're focusing on paying off their property. They've gotten rid of their car loans, gotten rid of their medical debt. So when they go into retirement, they're basically going to have to keep the lights on, pay for groceries and water, and then, whatever lifestyle they want to have in retirement, take a couple of vacations if they can afford it, have enough money for Christmas time, and then kind of live off their little nest egg that they have, and hopefully that compounds over the next 10 years or however long they choose to when they choose to retire. But if you really want to focus and you're getting close to retirement, really focus on your budget, your spending, and how much money you can make extra on top of what you're doing right now. Maybe take up a side hustle. It's never too late. There's 65-year-olds out there killing it on YouTube, talking about whatever they want to talk about. I mean, there's so many ways you can make money nowadays on the internet, and even not on the internet, just starting a business from doing Etsy or, whatever. Yeah. There's just so many different ways. But I say, if you can focus on that money going out and minimize those bills, that's one of the best things you can do to set yourself up for retirement if you're lacking that capital going into it.
And you know what? Like, that's an important message, not just for people close to retirement, but really any age. Yeah. If you can lower your expenses and keep those low as time, it's actually, especially for us younger people who see so much, they call it clout chasing on Instagram and stuff like that. Guys, stop. Okay. Stop spending your money. You're going to be so much better off. You're going to feel so much better. And like JJ was saying, if you are older, it's going to make it so much easier and more stress-free to retire that way.
Definitely. Cool. All right. So last question, I just want to do kind of a bonus question. Let's just say, since we talked a little bit more about somebody closer to retirement, let's talk about somebody who's maybe, 30, 40, something of that, younger, has some time in the market. If you had to pick, 3 or 4 ETFs for this person, just something super simple, which ones would you pick, and what percentages? Just real quick. You don't have to go too deep into it. Just what are your thoughts? I'm going to go first because I've already talked about this a lot on my channel and my people know what I'm going to say, but I do for the most part, an even way split between a growth fund, a dividend fund, and like a broad index. So for my growth fund, I really like SCHD. QQM, VUG, I like those. For dividends, SCHD is pretty much the only one I love that one. And then for me, it's the S&P 500 or VU, but VTI is exactly the same thing. So that would be me personally. That's what I would pick.
Mine's pretty simple. I mean, I feel like most 99% of investors are better off just investing in the benchmark, which is the S&P 500 or, the total stock market. And I feel 100% safe putting 100% of my money into VTI or VOO, letting it ride, never having to worry about looking at the market. Just keep putting money in every single week, every single month. You want to put more in when the market's down, because whenever it comes back up, you're going to be sitting pretty. But generally I say, if you have 100% in VOO or VTI, you're going to be set. If you just keep putting money in over your entire lifetime, it's one of the easiest ways to become a millionaire. Easiest ways.
Agree.
Yeah, I couldn't agree more with that, JJ. I don't even know if I could name 4 different ETFs, to be honest with you, but I love SCHD. I don't think you can go wrong there. And I honestly even think if you could get by with just that one. But, if you want some extra diversification, just go with something like a VU or a VTI. It's so simple. So simple. You don't need 5 or 6 different ones. VTI's got 4,000 different holdings in it. You could, if that's not diversification, I don't know what is.
Yeah. Well, and a real quick point to that too, like some of you guys out there watching right now, maybe hearing me say like, VTI, you're VTI, but you hold these dividend stocks and you have growth stocks in your other portfolio. That's a personal decision to me. And I'll even say it, I say it in my videos all the time. I know I will not beat I won't beat the market every single year. I know I won't. I'm not smart enough to do that. And like I said, 99% of the people out there aren't smart enough to do it every single year either. The reason I like to do it is because, one, I have a certain strategy on how I do things for, options trading. I like having different dividend stocks to, boost up my yield a little bit for that extra cash flow, because I plan on using my dividends before I hit retirement age. So that's one of the reasons why I do it. It's one of my hobbies. Yeah. I love researching companies. I love owning companies. I love when I go buy Starbucks that I'm like, hey, I'm contributing to me being a shareholder of Starbucks. So it makes me feel a little bit better about how much damn money I spend at Starbucks every single month. But no, I just wanted to set that clear, because I do invest in single stocks. But with that being said, I do think a lot of people should, if they don't want to do all the research and look into companies and manage their portfolio, invest in a broad-based index fund and you're going to be set. You don't ever have to worry about investing or what's going on in the market or what's going on macro or, China and Russia, whatever they're going to do. You don't have to worry about anything. Just keep the process, keep investing. And when you're 59 and a half or 60, or if you make it to early retirement in the 40s, you get early 50s, that's all you got to do.
Beautiful. Ryne, any closing remarks?
That's it, man.
Just what JJ great. Said, right? What JJ said.
Man, I'm telling you guys, just follow that guy. That's all you need to do. It's worked well for me.
That works out. Yeah. And I, thanks guys. Thanks so much for being on this with me. I know that people got a lot out of this, and my closing remark is just invest boring, people. I know a lot of people tend to just want to pick other investments only because they're bored of, well, I don't want to just invest in VU or whatever. But at the end of the day, you're not doing this to have fun. I mean, JJ is, but you're not doing this only to have fun. You're doing this you have a goal, you have a why. And that's where I usually bring people back. Okay, why are we investing? What's the goal? Okay, here is the way to get there, right? So at the end of the day, that's one of the things I like to say, invest boring. You don't want it to be so exciting that you wake up one day and it's too exciting and you have a heart attack because all your money's gone. All right, guys, thank you.
Yep, thanks, Dylan.